Hello, guys. So, today I would like to talk about a topic in economics, or rather, an interconnection between several concepts in economics and finance. That is uh, interest rate, bond yield, bond price, inflation. So, just a couple of months back, okay, there was a news that the U.S. bond yields have reached 16-year a 16-year high. Okay, so what happened was that there was a lot of interest rate, an increase in interest rate to fight inflation, and also that increase will still continue. That was the perception. So keeping that perception in mind, the yields went up, okay, and the bond prices went low. So the bond market was attractive for the investors. So basically, there is an inverse relationship between bond yield and interest rate, an inverse relationship between bond yield and bond price. So when the price goes up, yield goes down. When interest rate goes up, again, uh, bond price goes down. Interest rates are low means yield is low. Interest rates are up means yield is high. So for example, let's assume that a bond is priced, just for example's sake, like rupees 1,000, and the interest rate is 5%. So 50 rupees is the annual interest rate payment for that bond value. Now, if the bond if the interest rate goes low, it goes to, say, for example, 4%. So the bond price has to go high so as to compensate for that reduction in interest rate, so as to get the equivalent repayment of annual interest rates, or interest rate annual interest money, basically. So, applying that same logic, so Federal Reserve, as I said, there was a perception of increase in that they will increase the interest rates some few months back, and the bond yield went high. So what happened is that the equity markets, especially in the emerging economies, took a beating, and FII started pulling the money out of the equity markets, and started investing in the bond markets, US bond markets. And bond is anyways less riskier than equities, so the bond market giving high yield was attractive to them. Come December, now it is apparent that the Federal Reserve is holding the rates because there was some strong prediction of US going into recession in 2023, which didn't happen. But the probability of recession still looms in 2024. So what happened is that because the the rate cuts, or the rates are steady now, and because recession still looms, there is a prediction that uh, rate cuts are very much likely going forward. So what happens during in that case? If the rate cuts happen, then the yield goes low, the price of the bond goes high. So at that time, bond markets become less attractive, and FIs again start putting money into the equity markets. So equity markets in India, for example, they start showing like going up. The shares start going up, the indices, basically. So this is how the interconnections work, and this is the dynamics of uh, financial markets, and this is what I wanted to highlight. If you're watching this video, please like, share, and subscribe to my channel. Thank you very much.